Okay, welcome. My name is Volker Wieland. I'm Managing Director of IMFS. As people are coming in, I see we have a large audience. That's great to have you here as you still come in for the meeting, for the discussion, the webinar with Philip Lane, the ECB's chief economist. I'm delighted that we can put this together, and he has agreed to talk to us today about the ECB's policy strategy. As you see in the background here, I hope everyone can understand me well. We have technically Mr. Learman assistant. Mr. Learman, you tell me if the sound or anything is a problem. But looking back, you can see here the ECB and its Watchers. Last year, we had a conference also heavily with the engagement with Philip. We put together a conference. The president was speaking, President Lagarde, and it was an event to also contribute views of the ECB Watchers to the strategy review. The next ECB Watchers conference will be on March 17th. We will have a physical event if all goes well. Last year it was hybrid, as you know, but hopefully next year in spring we can welcome you all here again in Frankfurt. The invitees to this webinar also include many people from the general webinar invitation list, but also many of the ECB watchers, and we saw that many of you signed up today. That's great. So hopefully see you also in March. And we're delighted that Philip agreed today to basically give you a quick intro to, I mean, you've all been following this, of course, but give you a quick intro to the strategy review result and to the new strategy of the ECB with some important adjustments. And there we have also ample room for Q&A. So I'm delighted he's willing to discuss with us, and please enter your questions in the Q&A tool. You can start whenever you want entering there, and once we're getting to the Q&A part, we're going to start looking at those, and others can vote on the questions, and those with the most votes will move up in the list. Now, Philip Lane is well known to you. Nevertheless, let me say a few introductory words or facts. In '95, he received his PhD in economics from Harvard University. His first academic stint was at Columbia as an assistant professor for 2 years. Then he went back to Ireland to Trinity College Dublin, had big impact, further developing, of course, there. The school became professor. It really was there for quite a while. In 2015, he joined the central banking world directly by becoming governor of the Central Bank of Ireland. So he has been on the governing council since 2015, is well experienced, and since 2019, he's been helping lead or prepare and lead the ECB monetary policy through both the pre-corona period, but then very much the corona crisis. And as we now get out of this crisis, we're also very keen to hear from him about the new strategy and how it will impact policy going forward. So thank you, Philip, for agreeing to talk to us. I'll hand over directly to you. You're joining us from Ireland. Here we are in Frankfurt, and hopefully next year we're all meeting again physically here at the ECB Watchers Conference.
And thank you, Volker. Good afternoon, everyone. And Volker, maybe if you just share the screen, so you can put up my small set of slides.
Okay, I get started right away. So
yeah.
I will disappear, or at least on my side, you will see the slides. And Philip, you just tell me when you want me to move.
Well, I think you can go to the next slide. It's fine, actually. So that's just a picture of our building to remind us it still exists in Frankfurt. I would say, of course, next year, what a perfect date to have the ECB Watchers, St. Patrick's Day. So, of course, this reinforces the 17th of March as a good day to come together in Frankfurt. So this is a little bit of a process slide. Just to remind you that we said we would deliver in the second half of the year, and the 8th of July is the second half of the year. It represented a lot of work, really, that we launched. I mean, there was a pre-design phase even in late 2019, but in terms of the launch, January 2020, is very deliberately a Eurosystem review. So we called upon staff across the Eurosystem, not just the ECB staff. And the underlying work from those 13 work streams actually will be coming out in the next week or two before Sintra. So there'll be 18 occasional papers coming out. And that's, you know, for the professional economists, for those who are ECB watchers, there's a lot of rich material in those background papers. So I'm sure you should clear your calendar to study those carefully. So that is really the evidence base that led to three decision documents. One is the monetary policy strategy statement itself, the relatively short 12 paragraphs, which are essentially our declarations. I mean, declarations, conclusions, statements. Then we have this overview note, which again was decided by the Governing Council. So on the website, side by side with the strategy statement, is this overview note, which is around 18 pages. And that gives you some of the most important lines of reasoning to explain the high-level statements. So I do think that's essential reading, and it should be viewed as a decision document in the sense the Governing Council edited that, went through it, and agreed it. So that is important if you want the more elaborate justification for the high-level statement. And then there's quite a bit on the climate change action plan, so it made sense we had a separate release in relation to the action plan, giving you the timeline of work on climate change. So Volker, maybe if you go to the next slide. Okay, so now you have, this is the 12 paragraphs of the monetary policy strategy. And I suppose I want to spend a bit of time going through these 12 paragraphs and to explain why they are there. So the starting point is, you know, why are we having a strategy review? And maybe it's reasonably straightforward to accept that since the early 2000s, over more or less 20 years, there's a lot has happened. We've had the global financial crisis, we've had the euro area crisis, we have all sorts of structural changes in the world economy, and maybe a kind of a fundamental issue for monetary policy is the trend decline in the equilibrium real interest rates, or SAR. And that's going to be a basic issue which recurs throughout, is to how do we think about monetary policy strategy in a world where the equilibrium real rate has declined. Okay, so I think we give a more elaborate version of that in the 18-page overview paper. Next, we basically recall our treaty mandate. So this is, I suppose, a fairly basic point, is the strategy review takes the treaty as given, as fixed. This is not an occasion, because it's really not for the ECB to review the treaty. So we say, okay, as in the outside world, people might say, we'd like to see a different mandate for the ECB. We'd like to see a different treaty. That was not part of this review, because it would be odd for us as the ECB to question the treaty. Okay, and again, I think that's a fairly basic reminder, where of course the treaty gives us the kind of primary objective of price stability, but also it provides a foundation to take into account other factors relevant to monetary policy. And there's a well-known list of other factors in the treaty. Okay, so now let's focus on the primary mandate, price stability. So the treaty is pretty general about what that means. And so what we need to do is convert that into some measure of inflation that we're going to be focused on. And we confirm that the HICP is the relevant measure that we're going to focus on. So I think, again, that's a confirmation. But the extra step, the innovation here, is we do conclude that we would like to see in due time a revision to the HICP to include owner-occupied housing. And in the 18-pager, the overview, we elaborate on that to some extent. Now, we also say, we acknowledge that it takes a lot of time to get all the regulations, to get the Eurostat collection system, quality control, and so on. And so in the 18-pager, we give an indication of some timeline issues for that. But we also say in the strategy that in the meantime, we will take into account measures of unoccupied housing inflation in our wider set of inflation measures. So I think this is a point that people ask me quite a bit. So yeah, of course, we have our kind of main focus on the HICP. But I mean, honestly, all the time, we look at a whole range of measures. We look at the GDP deflator for some purposes. We look at trimmed versions of HICP. We look at core versions. We look at all sorts. So looking at versions that also allow for owner-occupied housing is already part of the information set, even if there's a lot more to do to bring it to the kind of main measure. By the way, on this basic point of what is price stability, we convert that into saying we think price stability is best protected by targeting a certain inflation rate. But in the 18-page, I think it's there, we do have a kind of qualitative definition of price stability, which is basically, price stability is a situation where inflation or deflation does not distort basically economic activity. Inflation is not so high or deflation so severe that it's distorting investment, consumption, the operation of the economy. So that kind of general definition of what is price stability. And then what are we doing? We're saying in order to protect that kind of a stable situation, we want to target a given inflation rate. Okay, so next step in the logical chain is we think that 0 is not the right number. We think we need an inflation buffer. We think we need to target an inflation rate above 0. Now, this has always been there. Is there in the review 20 years ago. And the reasons that existed 20 years ago, including measurement bias, including downward nominal wage rigidity, and including smoothing cross-country adjustment in a divergent euro area. All of those arguments remain. But there's now an additional argument, which is basically to preserve monetary policy space. You want to target a positive inflation rate so that nominal interest rates are sufficiently high in steady state that if there is an adverse shock, you do have the monetary policy space to respond. So that kind of macroeconomic argument was maybe not so prominent 20 years ago, but it's definitely an additional important reason to target a non-zero inflation rate, a positive inflation rate. Okay, turning to paragraph 5, what does that deliver? What it delivers on balance is a good target, inflation target is 2%, which of course many central banks around the world more or less are focused on. And that balances the different considerations. So I think it's not too surprising we would pick 2% on this occasion. It's also important for us to be maybe clear what we mean by symmetry, because we have used the phrase symmetry before, but probably not everyone would have a common, perfect understanding of what is meant. So now we try to be crystal clear. What we mean by having a symmetric approach is we view deviations from 2% in either direction as equally undesirable. That basically gives you a if you think about a symmetric loss function, a symmetric utility function, where it's symmetric around the ideal inflation rate. It's that kind of idea that you do equally dislike overshoots and undershoots. And essentially, this paragraph 5 also reminds everyone that having a clear point target is helpful and important in ensuring that inflation expectations are anchored at the target. And this is important. So compared to having the possibility of a band or something, the clarity of a point value is important. So of course, later on, when I talk about the medium term, of course, we don't say or claim we will continuously maintain 2%. There will be short-term fluctuations around it. Okay, so next, paragraph 6 is, of course, we would have spent a lot of time of this issue, which goes back to my opening remark, that the low equilibrium real rate generates issues for monetary policy. In particular, if the equilibrium real rate is low and you have adverse shocks or you're too slow to respond, then the effective lower bound becomes a constraint on monetary policy. That there is a lower bound to how much you can lower the policy rate, and you should take that into account in your monetary policy decision making. And I think we followed the global consensus in saying, in recognizing the effective lower bound means you should be more forceful or more persistent in your monetary policy decision making in the case of adverse shock. When you run the risk of getting closer to the lower bound, because essentially that provides some level of substitution for the limited capacity to cut rates by a large amount near the lower bound. And we basically conclude this paragraph 6 by recognizing, well, maybe a side effect or an implication of policies that are forceful and persistent might be a transitory period of moderate overshooting. So that may well occur even if your inflation target is 2%. The fact that you need to deploy forceful or persistent policies near the lower bound may generate essentially hump-shaped dynamics, where the route to 2% when you're coming from below may involve transitory period of moderate overshooting. Okay, so now we've got our inflation target. Now we've got the recognition that monetary policy should take into account the effective lower bounds. And then let's turn to paragraph 7, which is the medium-term orientation. Now, we always have had this. Every central bank will always recognize that monetary policy operates with a lag. But more generally, the optimal monetary policy response to a deviation, I think, again, I would imagine pretty universal, that you should take into account the magnitude of the deviation, the persistence of the deviation, and the origin of the deviation. So super transitory fluctuations, which will cure themselves, should meet a different monetary policy response to, for example, a sustained period of undershooting as we have had in recent times. The medium-term orientation also means we can take into account other considerations. Now, again, throughout the history of the ECB, there's been a recognition that, for example, adverse supply shocks that might have a stagflationary flavor should maybe meet a kind of a different response to some kind of demand shock. So, for example, basically, if you're a stagflationary shock, you might tighten policy more slowly and more mildly compared to an inflationary demand shock. So that has always, I think, been part of the lexicon of the ECB. But it's also important to recognize there are other risk factors, other shocks that can come into play. And for example, we mentioned financial stability as another consideration that may mean that you have a deviation from this target to take into account financial stability considerations. I should say the 18-pager elaborates on that, which is an important point. And then the occasional papers coming out will have a lot of material about the very nuanced and complex relationship between the topic of financial stability and price stability and monetary policy. Because of course, it's very context specific what the implications are for monetary policy. Okay, so now we've reminded everyone that we take a medium-term perspective. Of course, the medium term is also conditioned on the importance of anchoring inflation expectations. So it'd be not correct to kind of be too slow in returning inflation to 2%, because the longer you are away from 2, maybe the bigger the risk of de-anchoring in either direction. Paragraph 8 now turns to actually the conduct of monetary policy. So it basically opens up by saying, we're going to set monetary policy to deliver our target, i.e. to stabilize inflation at 2% over the medium term. So this is a clear orientation of monetary policy to the inflation target in the medium term. And we also make clear that the set of instruments, there is a hierarchy, which is under maybe so-called normal conditions, all we may need to use is the set of policy rates. But when you have a lower bound issue, when inflation is low and you have a constraint in the policy rate, it makes sense to turn to forward guidance, to turn to asset purchases, and to turn to refinancing operations, including targeted refinancing, as essentially ways to boost the kind of monetary policy space to provide substitutions for the lower bound on the policy rates. So this is important. It says we view these instruments as ways to address the lower bound. So they're not just there to fight acute deflation risk. They are there to overcome the lower bound or mitigate it and accelerate the return of inflation to the target. We also say that of course, we're always open to new ideas, that we reserve the option to use additional new instruments as appropriate. So that's a generic philosophical statement, that we don't say we have a fixed set of instruments. Okay, paragraph 9 basically says, how do we make these decisions? We make these decisions basically using an integrated analytical framework. So, of course, historically, the ECB made reference to 2 pillars, the economic analysis and the monetary analysis. And I'll give you my personal, it might be inaccurate, but my personal take on this, which is maybe, in the 1990s, let's say, you could conceive that in relation to inflation, that you could have parallel analyses. You could have the kind of economic analysis, and then in parallel, you could look at monetary aggregates. So my differentiation here by emphasizing the word integration or integrated framework is we think there's a lot of value. In fact, we think maybe there's more value than ever about understanding the monetary data, the financial data, for all sorts of reasons. One is, at this point, compared to 25 years ago, the whole world of macro recognizes there are all sorts of macro financial linkages. You cannot ignore the role of financial frictions. Now, they're time varying, they're more important in some states than other states, but the real economy is very much influenced by the operation of various types of financial frictions. So we need to understand the financial system. We need to understand the monetary data. On top of that, in terms of medium-term orientation and risk management, there's also information about the full distribution of inflation risk. So we don't only care about the most likely path, i.e. the expected inflation, we also care about the risk distribution. And there may be useful information in terms of the monetary and financial data about the tails, about the risk of high inflation or low inflation episodes. And for decision making, it's important to take into account those risks. And as many people on this call will know, there's a huge literature out there now trying to think about how to extract, if you like, tail information from financial and monetary data. So my personal view is actually, and I personally find super valuable, the monetary and financial analysis that goes into our monetary policy meetings. And really, it covers a huge range of topics. And again, coming back to the integration point, though, in the end, you have to draw together. We only make one decision. So we have to bring together the economic analysis and the monetary and financial analysis. Okay, let me then turn to paragraph 10, which is about climate change. Now, some of this is about, execution of monetary policy, about the collateral pool, about the corporate sector purchase program. But I think those issues are, I think, well understood. What I want to emphasize is we also think of it as a significant macro issue. So coming back to our economic and monetary policy teams, who are basically trying to work out all the time, both the conjuncture, what's going on right now, but also in terms of projections about what might happen down the track. Both climate change itself, in terms of more extreme weather events, whether it's wildfires, whether it's floods, whether it's here in Europe or around the world, where, for example, the semiconductor shortage right now, that seems to be connected in part to extreme weather events earlier this year, for example, in Taiwan. So there's a conjunctural element to that, but there's also a kind of a projection element, which is we know there's a significant carbon transition underway, which is going to accelerate, given the high focus on 2030 to get a lot of intermediate targets delivered. And so it's a big body of work to work out, what are the macroeconomic implications, and then in turn the inflation implications of this carbon transition. So we do think for macroeconomists, there's a lot there. Okay, paragraph 11 is about the importance of communication. We've already, so beyond the kind of I think global trend to trying to be clearer, more transparent, more layered, so that we don't just talk to the ECB watchers, but to a wider audience. We think that's important. We think it's important to maintain the interaction, the listening component, which is actually very useful. We learned a lot last year, not just from the round tables or other fora where we interacted with professional economists like this group here, but also the wider public events. So having that on a regular basis, and you've already seen some of the communication revisions, for example, the monetary policy statement, the revision to that. And I do think we over time, we also need to, for example, the economic bulletin, also maybe publish more of our background thinking, including, by the way, our kind of regular kind of proportionality assessments. So every so often, providing the outside world with our thinking about why our assessment of the proportionality of our monetary policy decisions, where we are on that. And then paragraph 12, I should say, the end, is it's important to have a regular review cycle, because otherwise, if you make it discretionary, where you say, well, when it's appropriate in the future, we'll call a review, then calling a review sends a signal that somehow you're unhappy with the current strategy. Whereas what we've done is we've committed that in 2025, we're going to assess the appropriateness of the current strategy. Maybe that'll be a shallow exercise where we say we're broadly okay. We don't have to do a big exercise, but maybe there's some subset of topics we need to take on. Maybe it'll be a wider exercise, but it's a good idea, I think, every time a review is done to signal when the next review is going to take place. So we've said we're going to take a look in 2025. I should signal that does not mean the full-scale review we did this time, given the 20-year lag since the last review. But we're open-minded about what may need revision in that time period. And so if you like, that becomes a little bit of a kind of continuous industry, because if we're going to do in 2025, whether inside the Eurosystem or outside Watchers, could already be lining up topics for us to take on in 2025. So feel free to get to work on that topic. Okay, I had no particular plan about how long I was going to spend. Maybe I spent too long on that intro, because of course the Q&A might be especially interesting. So I'll hand back to Walter.
Okay, thank you, Philip. Excellent. The last slide with the forward guidance you didn't want to refer to.
Oh, sorry. I mean, again, for the ECB Watchers, it was important to convert the strategy also into a concrete decision on rate forward guidance. And so in part of the Q&A, I mean, we do think this is basically mapping the idea of having a persistent attitude to setting policy rates near the lower bound. And so this idea that we need to make sure we're well on our way to 2% before we start lifting rates. And these various criteria help us with that. It's really an implementation of the strategic commitment to having a persistent approach to maintaining accommodation when we're near the lower bound. And recognizing with this level of persistence, indeed, this may imply a transitory period of moderately above target inflation. Okay.
Well, thank you. Thank you also for being willing to answer questions. Just let me remind everyone, several of you have already entered questions in the Q&A modus. So enter questions and you can vote on them. As we just give another minute for people to write in questions, one thing, I'll be reading the questions or quickly summarizing them so you can also hear them, and then say who asked them and hand over to Philip in each case. And as people still enter questions, let me start us off with one question, if you allow me. I wanted to ask you, and I'll basically stop the screen sharing so you can see Philip so I wanted to ask you, one of the big events since the last midterm review, then it was a midterm review, now it's a review and a review cycle, which I think is great. But one of the big events was the financial crisis. And so I wanted to ask you, what specifically do you think did you take out of the experience of the financial crisis in reshaping the strategy? People said there were many mistakes with financial regulation. Others said that the credit boom was also pushed ahead by monetary policy, or at least the monetary policy did not recognize it quickly enough. And also maybe this could be an issue regarding side effects and effects, both of the instruments you are using and you're now deploying very strongly also in this crisis. So maybe this is a first question, and then I'll start reading.
Okay, so that's a multi-layered question, Volker, as you know. So I mean, in this kind of exchange with Q&A, I'm going to give a partial answer because I'm not going to remember everything. So this is why I'm going to advertise the occasional papers. I mean, the work here is fantastic by the staff. So nuanced, balanced, complex, rich material. So all I say here is that whatever I say is subordinated to the more complete analysis in the occasional papers. So I think there's a whole set of issues. Maybe one basic point to mention is the interaction with the lower bound. So maybe this is not sufficiently in real time appreciated, that essentially, let's come back to the cause of the financial crisis. But once you have a financial crisis or the risk of a financial crisis, and of course, since we launched the review, we also had the pandemic shock, which is another example of a stress in the financial system. It is to recognize that a financial crisis is bad for price stability. It's, if it takes hold, if you have a significant and long-lasting financial crisis, it's very recessionary. It raises financial frictions. There's also risk premium go up, all sorts of frictions go up. and that has very negative macro consequences. So if you like, one basic message is you do need, if a serious crisis erupts, it does strengthen the case for monetary accommodation. So there is a cleaning role for monetary policy, once a crisis takes hold. I think that's important. And in terms of calibration, recognizing that the headwinds to monetary policy will be more intense if there's a lot of financial friction, which I think is probably everyone will more or less agree to that kind of statement. Then in terms of the kind of other side of it, it is, and again, I don't want to kind of localize to the actual crisis we observe, because that may not be the crisis risk we face in the future. I think we have a nuanced view about the build-up phase. It remains the case. It's a struggle to find policy rules. For example, leaning against the wind. It's a struggle to find versions of that are kind of pretty robust. So it's not the case that we think leaning against the wind is a universal principle, because there's all sorts of type 2 errors to that. On the other hand, I think I personally would also agree, and some of the staff analysis highlights that in a low interest rate world, if you're already close to lower bound, maybe ex-post cleaning is going to be difficult because you're near the lower bound. And that strengthens the case for avoiding financial crises in the first place. Because if you can't clean up afterwards, then you should take steps to kind of have a bit of prevention. But then, here there's an intersection with macroprudential policy. I think, again, the first line of defense remains the case. Comprehensive macroprudential policy can go a long way. But we don't rule out the kind of cracks argument that, maybe there are scenarios that you can find where the medium-term orientation of monetary policy does mean, and this goes back, if you go back to the academic literature, Woodford 10 years ago, it is kind of your willingness to moderate monetary policy for that kind of preventive element. That case is probably a lot stronger if inflation is more or less in the neighborhood of the target. If inflation expectations are anchored at the target, and therefore you can afford to kind of stretch the medium term. Where we are now, where we're still quite far distant from the target, where expectations are not at 2%, then the kind of calculus is probably a bit different. But in the end, I think our bottom line, or my bottom line, I should say, is this is something we will always be looking at. There's no fixed universal rules here. It's all weighing up pros and cons. And also, I should say there's also, when we have multiple instruments, there's also the kind of package approach. For example, can we alleviate some of the financial stability side effects of a given instrument? For example, I've seen some of my colleagues refer to tiering as a way to mitigate the negative interest rate policy. On targeted lending, we exclude mortgages to mitigate maybe its contribution to house speculation. So regardless of the stance implication, it's also, there's a layer of considerations in terms of the design of particular instruments. So that's kind of a very partial ramble through some of the issues, but I do think the occasional papers will help the more kind of coherent analysis of that.
Thank you. Let me take the first two questions together, or those who are highest on the list given votes. I think they fit together, and they fit to also your last statement. First, Martin Arnold from the FT, he's asking, given that the ECB is still forecasting inflation that will remain below target at the end of your forecast horizon in 2023, don't you think you need to be increasing the amount of monetary stimulus in the euro area rather than reducing it as you started to do last week? And Michael Bauer, a professor in Hamburg and former Fed economist, who asks, in a related way, what is the difference or what distinguishes the ECB's framework now, he calls it inflation targeting, from the flexible average inflation targeting of the kind the Fed has adopted? Could it be quite similar in practice?
Okay, good question. So, I mean, I think, and there's a recent CPR report many of you may have seen from about 10 days ago. And one of the points which I would agree with is it's not a good idea to identify the monetary policy stance with the volume of asset purchases, because, you know, the mapping from the volume of asset purchases to the monetary policy stance essentially goes through the yield curve. And what we have now is we assess that the yield curve remains pretty low. Not as flat as it was in mid-December last year, but remaining throughout the yield curve pretty supportive. We think the efficient approach is to, if you like, emphasize persistence. That we're going to be persistent in making sure that our policy rates do not tighten, that element at the short end that we control, we're not going to lift those until we're fairly close to 2%. And at the longer end, that we are, focusing on maintaining the favorability of financing conditions. So we are responding to movements in the longer end of the yield curve. So when there was upward pressure in March, we stepped up purchasing. Given that the improvement in the inflation outlook does mean we've made a moderate reduction in purchasing now. But I suppose my basic response is I don't agree with the premise that the volume of purchasing is a sufficient indicator of the monetary policy stance. So I mean, I would remind everyone, back in December last year, our 2023 core inflation forecast was 1.2. Now our 2023 inflation forecast is 1.5. So there is significant progress. We're happy that our monetary accommodation is strengthening the underlying inflation dynamic. I think over time, this will continue to build. I think we do have a coherent policy setting. And for that reason, another way to say that is, for a given nominal yield, the fact we now think the inflation dynamic is stronger means that, if you like, real interest rates are lower. And of course, that should provide additional stimulus. So the whole kind of debate about how to measure or summarize the monetary policy stance, of course, it is something we should always be communicating about. There's no one indicator, but we're happy that our overall policy setting is supportive of delivering our target in the medium term. Okay, so the flexible average inflation targeting. So I would say, the way I try and phrase it is, what we came up with in terms of saying that near the lower bounds, we're going to have forceful or persistent policies, is definitely in the same family as flexible average inflation targeting. They are both responding to the issue, which is there's a fundamental asymmetry imposed by the lower bounds. Now, what I would say around the world is that central banks in general are emphasizing patience and persistence. You'll see various central banks saying we're not going to lift rates until inflation has either arrived at 2% on a durable basis, or is within range, as we say. The additional, then the question becomes: is there an additional value by saying not only are we going to be make sure we're not going to lift rates too quickly, but in fact we want to add additional details or specification to that by saying we're going to aim for a moderate period of or temporary period of modestly above target inflation. We say our patient policies may imply a transitory period of moderately above target inflation. So, it is depending on the model you look at, does this make a big difference? I mean, maybe I'll go back to a lot of this is about the policy rate. We say we're not going to lift rates. Central banks say we're not going to move our rates, but that's not the only instrument. If you recall, the ECB is also using asset purchases. We're also using targeted lending. So in terms of saying, is this enough on its own to deliver 2%, to stabilize inflation of 2%? I think you need to look at the full monetary policy package, not just the forward guidance on the policy rate.
Thank you. Let me go to the next question by Jordi Gali. Very straightforward. Does the ECB have a view about the current equilibrium rate, R star? I mean, you certainly have given R star in your explanation a big role. What's your view where it is?
Yeah, so I mean, the ECB, I think there's some recent working papers, for example, by Klaus Brand and co-authors, which goes through various estimates of the equilibrium real rate. And clearly there's a lot of work, and clearly there's a lot of work also by the academic world. I mean, I think any point estimate is going to be surrounded by an error bound. I mean, it's definitely surrounded by uncertainty. But I think, our strategic conclusion is it's a lot lower than it used to be. And for our current orientation of monetary policy, the sensitivity of that to whether we pick one very low number against another very low number, I don't think the point estimate is maybe pivotal for the policy calibration. But what I would endorse is the general line of work that is coming out of the ECB. Which of course is not a million miles away from external techniques as well. So I don't really want to say any particular number, which because of course it's time varying. We all think it's time varying, and me citing one number today on September 15 will track me. So I don't particularly want to give a precise number, but I invite you to read the ECB work on the topic.
Thank you. From Chris Crow. As you contemplate the post-PEP policy environment, are there any elements of the pandemic emergency purchase program that you think worked particularly well? And, how would that be replicated? If so, how would that replicated in the programs after next March, right? That's certainly a question which many market participants
no doubt, but all I can say is it's helpful to us that we've concluded our strategy. So I think the productive use of watchers' time for those who are trying to anticipate what we're going to end up with is really to take very, very seriously what we wrote down, both in the 12th paragraph, in the 18-page overview note, which is, the Governing Council agreed, and the background papers. So we will be guided by the strategy. So that's my basic point. And then my other point is, in relation to the pandemic, we do think our policies have been, successful in dealing with the pandemic. And as Chris indicated, the interesting question is there any carryover or read across to non-pandemic times? And I think what we've said, the President said, I've said, is that we'll be working on this autumn. But I don't think it's very productive for me to kind of prejudge the work that's going to take place this autumn to kind of convert from different conjectures into a reasoned assessment of what the post-pandemic world should look like.
From Carsten Junius, a new element. I mean, and maybe not that expected element was the discussion of climate change, and he asks more fundamentally, is that mainly the primary or the secondary mandate of the ECB for which climate change is becoming a more central part of ECB monetary policy? And if I may add from my side, how far is it going to go with regard to the makeup of purchase programs?
So, I mean, the way I would think about it is there sufficient justification from the primary mandate? So there's sufficient motivation, but I think there's also motivation coming from the other objectives. So it's unnecessary for me, I think, or for the ECB or anyone to make the exact allocation, that this is, 95% primary mandate, 5% secondary. I don't find that hugely interesting. I mean, it would be a different situation where we thought it was not first order for the primary mandate. So let me be clear, we do think it's first order for the primary mandate. We do think it's important for it to deliver price stability that we take this on. And let me emphasize, it is, and again, especially for economic and monetary policy, my areas of ECB, the kind of most intricate issues are the implications for macroeconomic performance and for the inflation dynamic. The details of revising the corporate sector purchase program, revising the collateral pool, these are kind of all make sense. We're going to work on those because the details also matter, of course. But if you like, the main issue is going to be working at the macro implications and the implications for the inflation dynamic, which is basically central to regular monetary policy. So that would be my view. That's the big agenda item. Of course, those involved in operational framework, those involved in execution have to work out the precise implications for the corporate bond purchase program and the collateral pool and so on. But that operational dimension sits side by side with a much bigger issue of the kind of impact of climate change and the transition in particular on macro dynamics.
Cornelius Purps is asking, following the presentation of the strategy review and particularly the communication of the new forward guidance on rates, real rates, 10-year real OIS rate plunged. What is your explanation?
So I'm going to a little bit not fully accept the description of that question. I mean, we do think that, as an interesting issue about evaluating the market impact of a forward guidance announcement. So I would say for the econometricians out there, is that we do think the impact kind of was not just the first 5 minutes, that the market took a while to absorb what was a little bit novel forward guidance. So we do think in those weeks after the meeting, it clearly, I think, was understood by the market. We did see a pushing out of the lift-off date. We did see what we expected to see in terms of the kind of response of the yield curve, and it did contribute to the fact that we see a rise in inflation expectations, whether in survey evidence or market-based evidence. And what I would say, and I think Isabel Schnabel in her speech this afternoon to the bond market contact group also emphasized this point, and it's a more general point about the whole year-long experience. A lot of what's happening is, I think, both for the kind of economic structural fundamentals and then our reaction function, I think there's an increasing acceptance that low inflation outcomes are not super likely, i.e. there was quite a lot of weight placed on inflation outcomes below 1%, some weight even on deflation outcomes, and also weight on outcomes below 1.5. Whereas the distribution, I think, has shifted. The distribution has shifted where that kind of very low inflation outcome is being priced out. And what remains is, I think, the battlefield, if you like, is how quickly will we get to 2? how long are we going to spend in the mid ones versus 2%? And that is still a very important range of variation, but it's a more narrow debate than maybe the kind of fatalism that was around maybe pre-pandemic. And I think our forward guidance is contributing to that by being quite precise that we're not going to lift rates until we are, very much in the close neighborhood of 2%. Now then, as time moves on, shocks happen, we get news, and then you see movements in the yield curve, and then tracking what yield curve movements relate to us versus just the information flow that's coming. But I think the month of August, honestly, we do think showed that we do think the forward guidance is accepted, and coming back, then the allocation of contributions between the monetary policy framework versus the wider macro fundamentals. I mean, that's true globally. It's not just for the euro area in terms of driving longer term inflation expectations, investor perspectives on the world.
Thank you. Maybe let me take the next two questions together from Krishna Guha and Francesco Papadia, both regulars at the ECB Watchers conferences. Krishna asks, given the credibility of the new strategy depends on the use of instruments, is it reasonable to say that you should be willing to conduct QE on a scale that is sufficient to support an out-year inflation forecast of 2% on a durable basis? I read more QE, maybe a little bit like the first question. Francesco Papadia also mentions that you briefly referred to possible new monetary policy instruments. Given the failure to reach the price stability objective for more than a decade, he says, would this topic have deserved more attention? So more QE or more new instruments?
So, I mean, I think it's important to recognize, I mean, I think the ECB recognizes that. So let me say, I mean, let's imagine we're back in a world where inflation's at 2%. So we're back in steady state. Then I think it's kind of a reasonable working approximation to identify the medium term with the projection horizon, because we think monetary policy works on that kind of 18-month to 2-year horizon. So in steady state, that kind of grouping together of the projection horizon and the medium-term concept, I think is perfectly sensible and reasonable. However, when we have had a period of persistently low inflation, is it the case that, and this is the lower bound issue, is we can provide a lot of persistent accommodation, but if I was trying to, within 2 years, all else equal, raise the inflation rate from 1.5 to 2, that would require a very large amount of extra stimulus. And the lower bound does say basically maybe the pathway where you, and again, holding other policies fixed like fiscal and so on, which may play a role, that it may take more time to get to 2, but you hold your course. You are persistent, holding with a lot of monetary accommodation. So I'll basically invert that to Krishna, which is basically, if you inverted that and said, okay, here's the amount of monetary policy accommodation you need to hit 2% in 2023, I think the lower bound constraint plays a role here. You do need to be persistent and recognize it may take a bit more time, but in fact, that means you actually need to make sure you're as persistent and as forceful as possible. What I would say, honestly speaking, is that in terms of our instruments, I think we think the current set of instruments are working. It's not the case right now. I see, we could do a lot more by adding in an extra instrument. But we don't rule out that day may come where we need to add extra margins of monetary accommodation. Now, there's always going to be uncertainty. If you open up any new margin of accommodation, it's a leap into the unknown. So, the kind of the case for that will depend on the severity of the challenge you face. And so we keep an open mind on that. But I would say that you know, as you might imagine, we have views about all sorts of other instruments. But in terms of, you know, we do think the current set is doing the job.
Philip, we're at the end of our official time, just over 6 o'clock, but there are still a lot of questions. You think we can take another 10 minutes and touch on a few of these
sure.
questions?
Let's hit a 15 past the hour, so 12 minutes.
Excellent. Thank you very much.
Okay.
Let me take two questions together here. Basically, they're both on the climate issue. Anton Fischer asks about the trade-off between a monetary and climate policy. What about, will there be a trade-off? How will you handle it? What about the sector corporate neutrality of monetary policy in the future? Matthias Traut asks, if climate change and in particular mitigating measures such as the carbon tax constitute a negative supply shock, does the central bank look through such a shock, even if it's structural and may take several years to play out? Would that justify several years of overshooting the target, maybe because of CO2 price increases?
Okay, so I mean, in the end, everything is done in the context of delivering the price stability target. I mean, I would query whether, I mean, if we thought, so I suppose one bottom line in terms of our operational framework, we don't think there's a serious risk to the effectiveness of monetary policy by having revisions to the collateral framework or to the corporate sector purchase program. So I don't think anything that we will do would really, you know, inhibit the kind of monetary policy stance. So we definitely keep an eye on the monetary policy stance, but we're comfortable with the fact we can make revisions without really affecting the effectiveness of monetary policy. The second question, you know, I think the big topic, you focus on the supply shock element, but there's also, you know, going to be demand side implications of the green transition. And as always with negative supply shocks, there is a case for looking through, but it's also the case if you have the famous second round effect and you get generalized inflation dynamics seeded by the negative supply shock, then you have to address that. So I don't think there's a universal rule about this. And it is going to be, it does depend, of course, if you have a schedule of a decade of year on year, you know, quite visible increases in carbon prices, that kind of medium-term issue is relevant. Let me emphasize, however, that the mapping from carbon prices even to energy prices is non-obvious, because the scale of carbon in energy consumer prices across Europe varies quite a bit, depending on the role of renewables, depending on nuclear, for example. And of course, over time with technological change, the whole point of carbon taxes is to drive the expenditure rate to zero, close to zero. And so then it wouldn't be so important for inflation. So let's see. I mean, I think we're all going to be working on this. The CPR report that came out 10 days ago has a significant chapter on this, and there's going to be related work at the Sintra Forum in a couple of weeks. But I don't think there's any need to kind of take a very strong kind of back of the envelope view of this. It's something that will require all sorts of modeling in the coming year.
Thank you. Here's one question, Luca Branco. What about talk inside the ECB to change the target to around 2% rather than a fixed 2%? Could that be helpful? I guess it's something probably maybe you discussed. Chris Marsh asking about the TLTRO rate, whether it's disconnected from the deposit rate. Why was there no discussion of the lower bound on lending? How low can you go on TLTROs as opposed to deposit rates?
Okay, so I mean, of course, and I think the occasional papers will take it on directly, the pros and cons of a point target versus some kind of band. And I suppose, I mean, this seems a little bit of a kind of a secondary debate when we say we are medium-term orientation. So, you know, if inflation is a little bit above as it is now, or a little bit below, if we understand the reasons for those deviations and we think they're temporary, you know, the problem with a kind of band is it's the cliff edges, there's a discontinuity that somehow, let's say it's 1.5 to 2.5, somehow you'd have a discontinuous reaction if inflation goes from 1.4 to 1.6 or 2.4 to 2.6. And what, you know, I think honestly, our attitude is a more of a continuous reaction function. So we say our monetary policy takes into account the magnitude, the duration, and the origin of the deviation. So it's a kind of the further away, the more you care. It's probably in a convex way, at least in my sense, it's probably convex cost. You'd have to remind me now. The second question there was what?
Now I sorry. The TLTRO rate and the connection to the deposit rate. How low can you go on TLTRO? I mean, could that be an additional way to lower interest rates further than relative to the deposit?
So we obviously this is a significant decision by us as part of the pandemic response to use that margin, to use the margin that in a ring-fence way, but pretty significant given the take-up of TLTRO. And it's important, I mean, not just for us, but for the outside world to evaluate the effectiveness of that policy. Now, clearly, there's pros and cons. It's not kind of there's not only one-sided consideration to that. So what I would say is, you know, I think we think it's proving effective, but it requires, you know, always robust interrogation. You know, the fact it's been effective in the pandemic period doesn't mean it'll be universally always equally a good idea. So it's an important question that obviously inside the ECB we look at, but you know, I'd invite others to also look at it where they can.
So Michael Michaelidis asked, what about why not also announce forward guidance on asset purchases?
Well, I mean, we have forward guidance on asset purchases, which remains, you know, where we say we're going to continue net asset purchases until shortly before we raise rates. So the forward guidance on that remains. So, I mean, I think all forward guidance, including that forward guidance, can always be revised. But when people ask me that question, my turnaround is there really a gigantic difference between all the different versions of QE forward guidance you've heard around the world and in history? Because all of them end up basically saying we're going to raise rates before we end QE net purchases. That's a pretty universal conclusion, and there's going to be and also that there is and if you have rate forward guidance as we have, there's no read across from ending QE to raising rates. There's an independent set of criteria about raising rates. So I would kind of de-dramatize this topic, which is the fundamentals are always going to be more or less the same, and therefore the exact expression of the kind of criteria for moving to end of net purchases is not super interesting, at least from my point of view, because we are clear we will end before we raise rates. We are saying that our kind of core policy tool, our interest rates, so there will be a future condition where we're not doing QE and we're not even using forward guidance. That in the end, the kind of steady state may well just be the traditional monetary policy where you use the key policy rates and that's it. And it's something, of course, we will continue to communicate on. But I think if you get excited about the difference between shortly before and other kind of forward guidance, I do wonder whether this is a gigantic range of variation.
So maybe two brief questions. Sylvain Proyer is asking, how actually are you going to include the owner-occupied housing prices in your decisions as long as they're not included in the HICP? So what's the practice of that? And Daniele Antonucci asked how much moderately above target inflation is tolerated.
Yeah, so I mean, on the first one, I tried to indicate in my opening remarks, I mean, it's important to recognize we look at all sorts of inflation measures already. So what is true is we've kind of given you rate 4 guidance, which is explicitly about the kind of official HICP measure. So that is keyed to the HICP measure as it stands. But more broadly, every central bank, for example, once we have already lifted off, and then we decide, okay, how big a rate increase should we have? How quickly should we steepen interest rates? We're going, you know, all of those decisions have a risk management component where you look at it saying, well, okay, the HICP is telling us this. What does a broader measure, including owner-occupied housing, what might that tell you? What might the GDP say to tell you about the durability of the domestic component versus the foreign component of the CPI? All sorts of measures are used in calibrating interest rate decisions, in calibrating QE, and calibrating TLTRO. So I would say, I mean, it's always already been part of the conversation. But let me make a basic point here, because I get this question quite a bit. It is one of the issues with owner-occupied housing is we know what's happened. Ex post, with a lag, we have measures. But especially with the kind of property price component of owner-occupied housing, the connection between what just happened and what might happen in the future is not obvious. Because house prices can be volatile. If there's a run-up in house prices, does that mean there's more to come, or does it mean reversion and you're about to see a decline in house prices? So, you know, it's not like some other components of inflation. And the other point to note about owner-occupied housing is, let me just be clear that the house prices are a relatively small component. There's a large component which connect to issues such as renovations, to self-builds, to repairs and maintenance, and so on. So it'd be a mistake to kind of, for someone to have a back of the envelope calculation by saying, because I see a surge in property prices, this means there's a corresponding surge in owner-occupied housing costs. And also, I suppose that the bottom line of the analysis is, on average, it makes little difference, but I'm fairly sure it increases the cyclicality of inflation. So right now, there's upward pressure on house prices. But come any downturn, you could also have a more accelerated decline in wider measures of inflation. So, you know, it's important to take this on. I personally do agree that, you know, it's common sense to broaden the HICP to include what is a large part of expenditure for many households, especially when you take into account these other components, not just the cost of buying a new home. So yes, I maybe having said quite a bit there, the bottom line is we always take into account a range of indicators, which is basically in the balance of risk. You know, so it's not just we're not a mechanical, just looking at the point estimate of the HICP. We also take into account the balance of risk.
Maybe as last question, we can't answer all of them, but this last one, given the heterogeneous effects of the COVID crisis in terms of activity, fiscal deficits, and public debt, do you anticipate any risk for the ECB in being caught in a situation of financial fragmentation and fiscal dominance in the coming years?
I mean, one of the big initiatives after the Euro sovereign debt crisis is there's a whole machinery about, you know, with the European Commission, with now stitched into the national legislation of the member countries. There's a whole machinery to kind of install fiscal discipline across your area. So, I think that is basically means that this, I mean, we are projecting a pretty large decline in fiscal deficits in the coming year. Part of this is automatic stabilizers at work, the ending of pandemic schemes. So, I don't personally find the fiscal dominance narrative as super compelling, given Europe in general has a collective interest in not having unsustainable fiscal positions. And so much effort was put in to kind of having a collective framework to guard against that. So the fiscal policy challenge is to have sustainability while also recognizing, which by the way, in our 18-page overview paper we talk about, recognizing, especially near the lower bound, fiscal policy has an important counter-cyclical stabilization role, which makes the job of the ECB easier if that actually plays out. So I think we have this blend where we need sustainability, but we also need counter-cyclicality.
Thank you very much, Philip. That was excellent that you were ready to kind of offhand answer all these questions here publicly. Thanks a lot. I think we learned a lot about the issues, about the views, your views, the ECB's views. It was fantastic. Thank you very much. We're looking forward, of course, to the ECB Watchers Conference with you in March 17th. And there's still many participants here, so I hope to see you then. All the best. Thank you for your interest.
Thank you. Thank you.